Financial mistakes can happen at any age, but we're on today's episode going to focus on 5 of the most critical mistakes that you can make in your 60s as it relates to financial and retirement planning, how you can fix them or avoid them. We're going to ask financial advisor Frank Oliver those questions on today's episode. Let's jump into it. Back for another episode of The Time Blueprint. I'm Walter Storholt alongside financial advisor Frank Oliver. And Frank, we've got a good topic today.
Outstanding topic.
That pivotal decade of your 60s and 5 financial mistakes to avoid or fix quickly if you have made these mistakes.
Right.
So we've got a good list here. We're going to dive into them. We do have a good list,
yeah.
The last one is kind of a 2-parter, so we're going to cheat a little bit and get a 6th one in there, kind of. The first one to cover on the episode is ignoring retirement planning. So how do people ignore it? Because I imagine you get into your 60s. I'm just trying to put myself in folks' shoes here. How do I ignore retirement planning? I'd be thinking nothing but retirement at that point.
I think they're scared of it.
Okay.
I think they're scared of the plan. I think maybe there's a concern that they have not planned properly up until that point, and maybe now it's too late, and they don't want to know what situation they're in.
So this is the ostrich mentality.
Kind of, yeah. And I rarely run into a situation where somebody's going to be living in a van by the river. Exactly, But I do run into situations.
In Colorado, living by the river does sound kind of nice.
Does sound kind of nice, yeah, exactly. except for this week when it was 4 degrees.
Yeah,
exactly. So I think it's easier than people realize to put together a financial plan.
Yeah. Just
look at your overall situation, your assets, your income, your taxes, your Social Security benefits. And again, I talk about this all the time. An expense plan. How do you know if you're going to be able to retire if you don't know how much money you're spending, and if the assets you have combined with your Social Security are going to be able to support that budget? But once you have 4 basic components put together, and I'm not saying a financial plan should just consist of 4 basic components, but it's a good place to start to look at your situation. And I think if you at least started with those 4 basic components, cash flow, which consists of Social Security, how much income can my assets produce, my budget, and when am I going to retire? I think that's a pretty good starting point to at least start to generate some level of comfort with your retirement. We get much more complex than that on our financial, or retirement planning situations, or retirement plans, I guess. But it's not as difficult as people think. So just, don't be reluctant to build a financial plan. It builds some confidence for sure.
Good news, if you're watching today's video or listening to the episode on a podcasting app, you're probably tuned into retirement planning.
Sure.
And if you weren't, hopefully you are now after that one.
Yeah,
so
they need to be.
If you're in your 60s or about to hit that milestone or that decade, this is the stuff to pay attention to. So if we knock out that focus on retirement planning, that's a good step in the right direction.
Absolutely.
This next thing is central to your financial planning. It's in a lot of the verbiage that you talk about.
Sure.
It's in your tagline for your book and the business, and that's taxes and failing to utilize tax benefits. I think a lot of people just assume taxes are going to just be whatever they are and don't realize that they can really plan around those tax benefits and avoid certain things in the tax realm.
Yeah, 100%. So we're real big on Roth conversions, real big on tax-free retirement income. Okay. And I think what people fail to do, and I don't think that this accountants plan for the future. I think they just get buried with tax returns, especially this time of the year. We have the unique ability with our planning software to look into the future. And based at an average rate of return, what level of assets you have today, what your expenses are, and what your tax bracket is, what your required distributions are going to be, Social Security benefits, all of that. It just goes on and on.
To keep your eye on.
A couple additional details. We're able to look into the future and really determine what your tax bracket is going to be.
Okay.
And I think what people miss out on is the fact that when they retire, their tax bracket drops. And maybe that's an optimal time to look at doing some tax-free strategies, doing some Roth conversions, getting some funds from a traditional IRA or 401k into a Roth position. The sooner you do that, the sooner those assets grow tax-free. So when we look into the future and we see people electing Social Security at age X, let's just call it 70. Okay. And then today, required minimum distributions based on your age are going to be 73 or 75 probably moving forward. And when those required distributions hits, what's that going to do to your tax bracket? It may take some people from a 12% to a 22% tax bracket for the rest of their life in retirement.
Interesting.
With those big required distributions.
Big
and
issue.
it's a huge issue, you know? So I think people miss the opportunity to convert some of those funds to tax-free Roth IRA funds earlier when that tax bracket's lower, or at least look at it. You know, if you're in a 22% tax bracket today and you're going to be there forever, maybe it makes sense to do Roth conversions at a 22% tax bracket anyway, because if you're going to be there forever, at least get the funds growing tax-free now versus tax-deferred, where you get hit with that down the road.
So this decade's obviously important because you're in your 60s and you're usually going to be retiring in your 60s, at least the majority, but also because you can make a lot of decisions in your 60s that'll set you up for the rest of your life.
Right.
Okay, that's good.
Yeah.
All right, next on the list of 5 financial mistakes to avoid in your 60s is failing to protect your assets. What does that mean, to protect your assets? That sounds like one of those buzzword terms, but what's that really dial down into?
Yeah, I think you find some people that have had some very good luck in the stock market, right?
Okay.
Their assets have grown exponentially. And I think that buy and hold strategy works really, really well in the accumulation phase. But I think if we look back historically and look what happened to us in, 2008, 2018, 2022, part of COVID, and these events are going to happen again in the future, that if you don't have some of your assets protected and you're trying to generate income from those assets and the market takes a big hit, it could compromise it could be an irreversible mistake on your portfolio. Yeah. I mean, if your portfolio is at X and that drops down due to a 25% market correction, and you're pulling income out of those assets as the market's correcting by 25%, that could be irreversible. Those assets may never recover because you've pulled them down too far. So again, when we look at a financial plan, I think it's important to know how much do we need for cash, how much do we need to produce income, and how much do we need, in a growth bucket. Yeah. And I think that the level of protection should be on the amount of assets that are needed to produce income for a 3 to 5 year period.
So this is where that risk conversation really starts to come into the equation. Okay.
And again, like we talk about all the time, a financial plan, look at your budget, look at your level of assets, look at your Social Security, determine how much of those assets you need to produce income, and put some level of protection on the assets that are needed to produce income.
Okay. The next one, you just gave the buzzword away: delaying or taking too early Social Security benefits without a plan.
Right.
So it doesn't mean don't do one of those two directions, but do it with a plan in place.
Yeah, the Social Security topic has always been very interesting for me. So I have attended several high-end Social Security classes. We have several tech stacks that help us generate the optimal Social Security timing situation for a client. And I think with AI and ChatGPT and Google, the easiest thing to do is get on your computer and type, when should I elect Social Security, right? Yeah. And you're going to get 10 million different opinions on that.
Sure.
And most of the opinions—
Or a biased opinion.
Yeah. I think more than not, people are getting information that says I should elect Social Security early, because if I wait until, a later age, it's going to take me 10 years to make up that income that I left on the table by delaying Social Security, But what we do is we look at it from an entirely different standpoint. Again, we run a plan, right? Yeah. And we look at it from a tax standpoint, a budgeting standpoint, longevity standpoint. We also look at it from a survivor standpoint. Yeah. I don't think a lot of people take into consideration, if you had a spouse that was a junior earner, maybe taking care of the family, raising the kids, right? That the primary earner's benefit transfers to the secondary earner if that primary earner passes away. So if the primary earner elects early because they Googled when should I elect Social Security and something told them to elect early, and they pass away next year, that surviving spouse is left with a smaller benefit for the rest of their life. Right. Social Security benefits are also tax-free. People don't realize that. They're only taxable when you calculate in the provisional income and add other income to that. So if you can elect a larger benefit that's more tax-friendly, then you rely less on your own income, lowering your tax bracket as well. So a lot of things go into consideration other than Googling when should I elect Social Security.
Yeah. I mean, you could be reading a source, not to go down a conspiracy theory rabbit hole here, but you could—
Or we can.
Yeah, sure. You could potentially be reading a source where it's in their best interest for more and more people to, let's say, take Social Security early.
Absolutely.
Because they're getting you to take a reduced amount. And so maybe that benefits a government agency of some sort to have you do that. So that information is a little tainted or biased, and it could go the other direction too.
Could be.
So just something to be aware of, that you should be getting unbiased advice. I think of it this way: if you find yourself about to walk into the Social Security Administration and you don't have a financial plan in place,
and they tell you to elect early,
stop what you're doing, back out, go get a financial plan, and then you'll know when to elect Social Security.
Absolutely. Yeah.
So don't do that before you do the other.
Correct.
All right. Last but not least, we're going to combine these into your fifth financial mistake to avoid. And it's because one's an over and an under on the same thing. And that would be over-reliance or under-reliance on fixed income. How does one over or under rely on that?
Well, fixed income, over the last 10 years has been an underperformer. There's no doubt about that. There's been some I'm not going to say innovations because these products have been around. We call them structured notes. They've been around or structured products, I guess. They've been around for probably 15 years. And I think when people look at fixed income, they're looking at that to produce income in retirement. So as we get closer to retirement, people are geared to reposition a lot of their assets into fixed income. And again, I think what we need to look at is how much income do we actually need? So if you've saved $1 million, do you need that entire $1 million portfolio to produce $2,000 a month? No, you need a portion of that $1 million portfolio to produce $2,000 a month. So find a fixed income product, whether it be dividend paying stocks, bonds, bond funds. We prefer structured notes because we're getting 2 to 3 times the coupon off of a structured note than people are getting off of traditional fixed income. So look at what your negative cash flow situation is. So your Social Security and your pension is X, your budget is Y. What do I need to fill that gap from my portfolio? And then use that portion, put in some kind of fixed income or fixed income alternative, like we're using like the structured note products to produce that income. And then the rest of it can remain in a different growth position. So, and I don't know if that answers the question correctly but I think a lot of folks as they get older decide, traditional investing 101 is as we get older and move further into retirement, our portfolio needs to become more conservative. I disagree with that. I think a portion of the portfolio should be more conservative, but just that portion that's needed to produce the income that you need for sustainable retirement. But that allows you to invest properly with the rest of it so you actually have more money down the road. So
like an over-reliance on fixed income could be somebody that's like, oh, I've just got to buy a whole bunch of CDs and annuities or things that are going to provide me this income, but they just overspend on that so maybe that's an inefficient way to do it. But it could also go the other way where somebody gets scared of fixed income products.
And they're too heavily
in the market.
Invested in the market, exactly.
And now they're dealing with that fluctuations and those stresses.
And we're coming off a couple very, very outstanding years in the market. So I think
will that sustain? We don't know.
What goes up is going to come down. I mean, the markets do not go up forever, so they will come back down. And I think when you see people very excited about their portfolios growing and they enter retirement, sometimes they're reluctant to slow down that growth. But again, that's where looking at a plan, knowing how much money you need to produce from that will allow you to still remain in the market. If you want to have the majority of that portfolio in the market, just shave off a little piece of that to go into some solid fixed income position that will produce the income you need. You don't need to put your whole portfolio fixed income, and it shouldn't all be in equities. There should be a balance of that. So not necessarily a Swiss Army knife approach where one portfolio is supposed to do everything. We actually kind of bucketize that and create different scenarios.
Okay, very good. Makes a lot of sense. Well, there you have it. 5 mistakes to avoid in your 60s. Leave a comment in today's show if you're watching on YouTube. Leave us a comment. Let us know what mistakes that you're worried about making in your 60s, or if you did make a mistake and you fixed it, or you worked with an advisor who helped you avoid a mistake. Call those things out. It would be interesting to see where people either have stumbled or were about to stumble and got back on the right path. If you need help with your financial plan, of course, you can meet with Frank and the team at Oliver Asset Management. If you're in Colorado, he's based in Longmont. It's easy to come by and meet in the office, but if you're outside the area, you can always meet remotely as well. Schedule your time to visit at oliverassetmanagement.com, and we've got more contact information in the description of today's show. Wherever you're watching or listening should be easy to find. Frank, thanks so much for the help.
Thank you, Walter.
All right, we'll see everybody next time on The Time Blueprint.
Thank you.
Investment advisory services offered through Creative One Wealth, LLC, a registered investment advisor. Oliver Asset Management and Creative One Wealth are unaffiliated entities. Licensed insurance professional. This information is for educational purposes only and should not be construed as advice or a recommendation for your specific circumstances. Investing involves risk, including possible loss of principal. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. We are not affiliated with any government agency and do not provide tax or legal advice.